Good morning, everyone. This is Barry Knapp with Iron-Size Macroeconomics. Pardon me. It's Monday morning, October 4th. Our note this week was particularly dense. It is titled Risk Off and was released on Saturday morning, October 2nd. There's 5 sections to the note this week. One about tighter financial conditions and the sequencing of how a risk-off event happens. We think we're in the midst of one, and it'll probably carry the equity market down another 5% or so to roughly 4,100 on the S&P 500 is our expectations. The next section was an economic review. We titled it Muddy Economic Waters. We then wrote about negative revisions. This is earnings revisions, and we'll explain it in a couple of minutes, but it's a particularly important concept for equity investors. We then wrote about all the comings and goings of the FOMC and likely compositional changes and what that'll mean for policy in both the near term and longer term. And then wound the report up with a discussion about the infighting down in DC on the budget. So one note before I get started, we did send this to our entire list, both free and paid subscribers. We're giving a presentation tomorrow on our 60s analog. You can see that information. Hopefully you got the email, but it's going to be Tuesday, October 5th, 12 to 12:30 p.m. It's on it's with an organization called The Money Show, and it'll be broadcast virtually. So please have a look at that. And you could also go to our website and see the information on that. So moving on to the subject of the report. First, on the risk-off sequencing and how these risk-off events unfold, we had a significant move higher in real rates. As we've been saying throughout this Fed intervention process, that QE bond buying, that they're buying 100% of the supply of Treasury Inflation Protected Securities, TIPS. They're buying 100% of the supply of mortgage-backed securities. When they ease that buying, it's going to drive up real interest rates and going to drive up volatility. We've seen volatility go up a bit, but what we've really seen move are these real interest rates or the TIPS yields. We've had actually a bigger move than we had in the 2 spikes in 2018 during balance sheet contraction that triggered risk-off events. The first one was 30 basis points in 10-year real rates in January, and then Volmageddon in February. The second one was another 30 basis point move in September that triggered the global QT crash in the fourth quarter of equities of 2018, that is. So we've had significant moves in real rates. This is a significant issue for the dollar. We're also getting sharp moves higher in rates in Europe, but in that case, it's being driven all by break-evens. We think it has a lot to do with the energy crisis over there. We wrote the week before in an inflation summary about how energy prices were going to play a bigger and bigger role in the inflation process in the 2020s. Just dismissing them was a bad idea because they're just so pervasive, and it's unlikely we're going to have anything like the energy supply shock that occurred as a consequence of the shale technology revolution in the 2010s. But as a consequence of those rates moving higher because of inflation, and if inflation drives rates up, it's generally a currency negative, whereas rates are being driven up by real rates in the US, which is more of a currency positive. So on balance, the euro had a fairly sharp decline against the US dollar, but it's not just the euro. In fact, the dollar is up against every major currency over the last month or so, except for the Canadian dollar and ruble, which is to our energy point, and the Chinese yuan, which we think is definitely a function of, or likely a function of, intervention by the PBOC because they're concerned about those outflows. Were the dollar or the yuan to start to weaken, then those outflows could really get exacerbated. And that's why we think that's happening. But all of this put together is, higher real rates, a higher dollar, lower stock prices. This is what a risk-off event looks like. And we don't see any reason why that dollar trend wouldn't continue and the risk-off in equities wouldn't continue as well, taking us ultimately down 10% or so from the highs, as we've been talking about for months now. So that's it on the risk off sequencing and how we don't think the correction is quite done. The next section was titled Muddy Waters on the incoming economic data. First of all, we got very favorable data on capital spending. The core capital goods orders numbers were quite good. The capital spending plans out of the various Fed surveys have all been good, but not just for manufacturers, also for technology companies and service sector companies. So we have a really strong building CapEx story. We think that's going to be a real feature after our risk off event is done and as we get into 2022. The next thing we wrote about was the inflation report we got last Friday. And you are seeing further acceleration in cost of all household goods, but you're still not moving medical care or housing higher. And those are coming for sure. So I think all of this has led to a loss of credibility for Team Transitory, if you will, because it does look like this inflation impulse is going to persist for much longer than anyone expected. And then finally, we wrote about the labor market ahead of this week's all-important labor data. And the picture's become quite muddied through the course of September. We expected, as those unemployment benefits ended, that we would see sharp declines in the various continuing claims programs. We're not sure what's going on with the reporting of that, but they haven't fallen as much as we expected. It's not clear whether some states haven't found a way to extend that, perhaps using the direct transfers they got from the federal government. The Biden administration did allow for that. And you could see in New York and California's insured unemployment rates, those have remained high relative to what we've been calling the focus protection states, Florida and Texas, where those had been down for quite some time. So the labor market supply bottleneck does not appear to have cleared as quickly as we thought in the month of September, and it creates a lot of uncertainty around this Friday's reports. Consensus are for a doubling of the payroll gains in August to something like 450 or so. We do think that August is likely to be revised higher. Demand looks like it's still strong. Looking at the Conference Board labor differential series last week, that was reported for September, that remains near all-time highs, but it's just not clear to us that the bottlenecks have really cleared and that we're going to have a strong print. So that's it on that. We'll try and put out our preview for our paid subscribers prior to the report on Thursday or on Friday if we think we have some real value to add there. So moving on to net revisions. This is an important concept for equity investors. Net revisions is in essence the diffusion index or ISM PMI series for analyst estimates. We take the number of analysts increasing estimates less those decreasing estimates. So it's a real rate of change leading indicator. And it's started to roll over quite hard, actually. We've been talking about how the S&P 500 estimate went from 163 at the beginning of the year all the way to 203 by the end of August. But then it's slipped a little bit through the course of September down to 202. That's all it takes for revisions to start to move lower. Remember, it's the rate of change of earnings growth that really drives multiples. When earnings are going up rapidly, multiples go up, expand as well. When revisions start to go down, the multiple generally comes under pressure. And that's what we see occurring right now. Given that it's being led by the staples sector, we think the market may be overreacting to this prices paid versus prices received argument, marginal cost versus marginal revenue. Fixed costs haven't changed and revenues are going to be higher. So we do still think there's operating leverage. If the S&P does fall another 5% by the time we get a week or two into earnings season and those revisions have come down sharply, it could actually turn into an oversold situation, so to speak, and the market could react favorably to earnings estimates. But we need to do some more price damage before we think that the market would be set up for that. So that's it on revisions. Moving on to the FOMC, we found that the resignations of Kaplan and Clarida, not Clarida, not yet, but Kaplan and Rosengren were regrettable. Those were two of the FOMC participants that really understood the unintended and negative consequences of asset purchases Clarida now looks like he might be in some degree of trouble, though. As far as we can tell, all he did was a standard rebalancing based on price movement, and probably should have been doing that. But nonetheless, Clarida was the real driver of policy within the Fed. It's not Powell, it's Clarida. Clarida is likely to be out under any circumstances, particularly given this newfound controversy, which is a real shame because we do think he's a real heavyweight. And what we're going to be left with at the Fed is very few FOMC participants with any capital markets experience. As it stood, there's 3 or so with any investment management experience, no one who came from the sell side or banking side of the business now that Kaplan's gone. And we have mostly academics and FOMC staffers for life. So we just think that's a real miss. The FOMC could use people that have been in the trenches. We don't think this will change policy in the near term. The taper is, that battleship has set sail. They're ready to go on that. And they will continue through that. It may have something to do with the timing of liftoff when they first raise rates. And this does make our 60s analog really look quite strong. We also think we're going to have a very negative turn in terms of bank regulatory policy based on the new composition and who becomes the new vice chair for supervision. That's definitely going to be a negative for those bank stocks. We'll see how acute that gets. We're not willing to give up on our overweight on them at this point, but we raise that as a real point of caution. Then finally, wrapping this up this week with the DC infighting, we put a couple of good links in the note, in the full note, that is for paid subscribers, a couple of good, really good resources. One, the Penn-Wharton budget model and how it'll, the tax hikes will degrade our global competitiveness. On the corporate side, the Tax Foundation had a pretty good report out last week as well. Listen, we think that if the only good scenario here for the markets and the economy is if the whole thing collapses. We do not think the infrastructure bill is any panacea. Infrastructure is not supposed to be done at the federal level and really isn't done at the federal level. Federal spending on infrastructure makes up 4% of total physical infrastructure. This really is done at the state and local level. This infrastructure bill to us is on balance a minor net negative. And the Bernie budget, of course, is a major net negative for the economy, for dynamism, for the corporate sector from the perspective of an equity investor. So nothing here is particularly good. The fact that it's hung up is probably a minor net positive at this point, but we still think it's likely they'll get some deal done that will be a net negative for corporate earnings. So that's it for me this week. Should be an interesting one. Payrolls at the end of the week is of course big. It would need to be very, very weak to prevent the Fed tapering battleship to go back to docks or ports, so to speak. But it will still be an important report for just the perspective of investors about how much economic momentum there really is. So Barry Knapp, Ironside's Macro. If you're not already a paid subscriber, we'd love you to consider becoming one. Have a good week, everyone. Thank you.